CGT stands for capital gains tax. In this video, we are going to demonstrate how you calculate a capital gain and a capital loss when a CGT asset is sold. In order to have a capital gain or a capital loss, you need to have had a CGT event for the year. There are many different types of CGT events, the most common being Event A1, which is the sale of a CGT asset. A CGT asset is defined as any form of property or legal or equitable rights that are not property. By way of example, it could include a house, shares in a company, a piece of artwork, rights under a contract, and many, many others. A number of assets are exempt from CGT, and we will consider some of these exemptions in class. Two major exemptions are assets acquired prior to 21 September 1985, when CGT was introduced in Australia, and your main residence. Let's now work through an example of CGT event A1. We have a taxpayer, Ms. Smith, who is selling a house, which is a CGT asset, to Mr. Jones. We are going to assume that it was not her main residence, and she also did not use the house to produce income. That is, she didn't rent it out. The time of the event is when the contract is signed, or, if there is no contract, when the change in ownership of the asset occurs. She will make a capital gain if her capital proceeds exceed her cost base. She will make a capital loss if her capital proceeds are less than her reduced cost base. Capital proceeds are generally the money you have received or are entitled to receive in connection with the CGT event. Let's pretend that Ms. Smith signed a contract to sell her house on 1 September of the current year for $800,000. She receives a $100,000 deposit. The remaining $700,000 is received on 1 October, when settlement of the house occurs. The CGT event occurs on 1 September, and her capital proceeds will be $800,000. Ms. Smith will then need to calculate her cost base. The cost base, in simplified terms, is costs you have incurred in respect of the asset. It consists of 5 elements. The first element is the cost of acquisition. That is, the money you paid or are required to pay in respect of acquiring the asset. In this scenario, it is the amount that Ms. Smith paid when she first purchased the house. Let's assume she purchased the house for $500,000. The second element is incidental costs you incurred in relation to the CGT asset or the CGT event. Some examples include agent fees, conveyancing, stamp duty, and borrowing expenses. When Ms. Smith purchased the house, she paid a lawyer $1,500 for conveyancing. She also paid $15,000 in stamp duty and incurred a $500 mortgage application fee. Later, when she sells the property, she pays her real estate agent $5,000 in commission. Assuming she had no other incidental expenses, the second element of her cost base would be $22,000. The third element is the cost of ownership. That is, expenses that relate to owning the CGT asset. Examples include interest on money borrowed to acquire the asset, costs of repairs, rates, or land tax. During Ms. Smith's ownership period, she incurred $80,000 in interest on her mortgage. She also paid $6,000 in council rates and $3,000 in land tax. A storm caused damage to her roof, which she then repaired at a cost of $4,000. The third element of her cost base would be $93,000. The fourth element is capital expenditure, incurred to increase or preserve the asset's value, or that relate to installing or moving the asset. Ms. Smith installed a swimming pool for $12,000 and paid to convert the carport into a garage at a cost of $6,000. The fourth element of her cost base would be $18,000. The fifth and final element of the cost base is expenditure incurred to establish, preserve, or defend your title to the asset or a right over the asset. Let's pretend that Ms. Smith had a dispute with her neighbour over the fence line. She paid $2,000 in legal fees to defend her title to her land. This would be an example of a fifth element cost. Adding the 5 elements together, Ms. Smith's total cost base is $635,000. Note that you will not always have costs that fall into each cost base element. Also, if Ms. Smith had been able to claim a tax deduction for any of these costs, which would have been possible for some of them if she was renting out the property, they would not be able to be included in the cost base. In this case, as her capital proceeds of $800,000 exceed her cost base of $635,000, she has made a capital gain of $165,000. Now, we'll pretend that instead of Ms. Smith selling the home for $800,000, she only sold it for $520,000. The capital proceeds of $520,000 do not exceed the cost base of $635,000, so she has not made a capital gain. In this situation, she would then need to calculate her reduced cost base. The reduced cost base is largely the same as the cost base, but does not include third element costs, that is, the costs of ownership. In this example, her costs of ownership were $93,000. If we exclude those, her reduced cost base is $542,000. As her capital proceeds are less than the reduced cost base, she has made a capital loss of $22,000, the $520,000 less the $542,000. Finally, let's pretend that Ms. Smith sold the house for $600,000. This amount is greater than the reduced cost base of $542,000, but less than the cost base of $635,000. In this case, while she has still had a CGT event, she has not made a capital gain or a capital loss. At the end of an income year, a taxpayer will need to calculate the capital gain or capital loss from all the CGT events they have had during the year, as these figures are then used to calculate their net capital gain or net capital loss for the year. We will discuss the calculation of net capital gains and net capital losses in class. A net capital gain will be included in a taxpayer's assessable income. A net capital loss is quarantined, but can be used in future years to reduce future capital gains. To recap, you cannot have a capital gain or a capital loss unless you have a CGT event. The most common CGT event is Event A1, disposal of a CGT asset. For Event A1 and most other CGT events, you will make a capital gain if the capital proceeds are greater than your cost base, and make a capital loss if the capital proceeds are less than your reduced cost base.